going to give you an overview of a system that's similar to the one that I use, an overall market filter to manage the money similar to the one that I use for my clients in my own money. It's not perfect, and it's also not a crystal ball. It doesn't tell the future. It's designed to ignore the noise and ride out the short-term volatility, yet alert investors to major changes in the market, such as bear markets. We want to avoid those if possible. So to recap, I want to ride out the short-term volatility for a couple of reasons. Mainly, anytime you use a numbers-based methodology, it takes a while for that bad data to show up. And since short-term drops could and often do reverse in a matter of days or weeks or usually months, if you change your investments every time there's a short-term change, you could sell just when the market is turning around and buy after a substantial run-up, like this. But I do want to be alerted when the market moves into a bear market, because typically bear markets last a lot longer and they drop a lot more. So if I can get out early once a bear market starts and get back in after the recovery starts, it won't be doing it at the ultimate best time, but I can potentially avoid some of the losses and some of the emotional anxiety associated with bear markets. Now, I've been spending the last 17 years looking for a solution to this problem and getting closer and tweaking and improving and so forth. And over the years, I've experimented with my own money and then implemented what I found that worked, and again kept trying to improve over the years. And again, I'm not going to show you the exact method that I use, but something pretty close to it. I can't make promissory statements for compliance reasons, but I do. So I don't want to show you the exact thing because I don't want you to think that I can guarantee results. But I want to show you something that shows the pros and cons of using a numbers-based system. This again, when it has a buy signal, you're in the market. When it gives you a sell signal, you get out of the market. Why is that? Because if the overall market is weak, most ships rise and fall with the tide, and as a result, if the market is weak, I sort of want to protect my holdings, and there's a good reason to suspect that they'll go down if the market is weak. So the first thing I want to point out is that since 2010, the signal has been long. It's been in a buy signal. Now, during that time, we've had plenty of short-term dips. This system said ignore them. Like in 2011, the market dropped almost 20%. This system said ignore it. It turned out that that suggestion was right. And the long-term results were very good. It's not a guarantee of the future results. Now, there's no way this system knew that this would be the case, because it doesn't predict the future. It simply said that the numbers didn't justify making a change at that time. But still, investors had to suffer through a 20% loss there and hold on. I also want to point out there's a couple of other data points in this back-tested graph where the system said it was time to sell in early 2008. Now, that wasn't the perfect time to sell. It would have been perfect to do it a few months earlier. Like I said, every numbers-based approach gives us a late signal. But that signal was still helpful to investors in this case, as they were able to sidestep much of the financial crisis for the most part, and they were able to avoid seeing the huge drops that people who held on to suffered. No guarantee of the future. And then in 2009, the system said it was time to buy again. Again, that wasn't the best time. The best time would have been a couple of months earlier. So the investor paying attention to this signal would have bought in at prices a little higher than the person who bought in a few months earlier if they had a crystal ball. But no one has a crystal ball. People using this system had an objective system telling them it was time to re-enter, but it wasn't perfect. And I want to point out that along the way there were other stops. Back in the past using the system, we can see that the system suggested it was time to get out of the market, and that was wrong, and the system quickly reversed itself and told us to get back in. And this happened a few times, and it cost the investor money because they had to buy back in at higher prices, and probably this triggered a realization of capital gains tax as well. So it wasn't a good result. But getting bad signals or false positives is part of the game when you use a numbers-based method. This happens, and it's unavoidable. The idea is, and the hope is, that these mistakes are infrequent and they are less expensive and more than made up for by the times when the signals are accurate. Now, to me, those mistakes or false positives aren't a big problem and well worth it. It's sort of like an insurance policy, if you ask me. This system has done a good job back-tested differentiating between most corrections and most bear markets, but it wasn't perfect. Now, you might feel the same way, but I want to point out another thing. What I'm showing you here is a back-tested system that I don't use. It's very close to what I use, but it's not the exact same method. And I also want to point out that there's no guarantee that this or any other investment strategy will continue to work in the future. There's no guarantee in the least. I use this method or similar method because compared to the alternatives, I think it's the best way possible to help clients grow their money safely over the long term, to achieve their life goals without having to worry about it. Is it perfect? No. Is it guaranteed? Of course not. But compared to every other investment strategy, I believe it's the best possible choice. In my next video, I'm going to summarize the pros and cons of the different investment strategies to help you put together a decision on what works best for you. Thanks.